Citi just lifted its 0 to 3-month silver forecast to $150 per ounce. At the same time, MKS PAMP SA says silver demand is immense in a way they have not seen before. And while that's happening, silver is being air freighted because buyers can't wait for ships. That combination is not noise, it's a signal, and it's why silver is the story right now. If you want clear, no fluff breakdowns like this, subscribe, then turn on notifications so you catch the next update the moment it drops from the Metal Alarm Desk. And if you've been watching metals lately, you know something historic is unfolding. But what happened in the last 48 hours should make everyone pay attention. Gold is trading at all-time highs, and we just got validation from two completely different angles within hours of each other. When you connect these dots, the picture becomes undeniable. First, Reuters reported that Citi raised their 0 to 3-month silver forecast to $150 per ounce from $100. That's a 50% upgrade, near term, not someday. A move like that, in that time window, is Citi telling you the risk profile just changed. Then Bloomberg published an interview with James Emmett, CEO of MKS PAMP SA, one of the world's largest precious metals refiners. His exact words, there's immense silver demand in a way that we've really not seen before. So you've got the paper side and the physical side sounding the same alarm. When a major bank that trades paper futures and a major refiner that moves physical metal both tell you the same story on the same day, you pay attention, because that is paper and physical pointing in the same direction. Now let me walk you through what's happening here, because this isn't coincidence. This is convergence. Citi operates in the derivatives market. That means they live in contracts, positioning, and risk being managed through paper instruments. They see COMEX positioning, client flows, and hedging activity from institutions. They're watching who is leaning the wrong way, where the pressure is building, and how quickly that pressure can turn into forced buying or forced selling. So when they raise a near-term target by 50%, they're not doing it to sound bold. They're managing risk. They're telling their trading desks and their clients to prepare for a move that could burn anyone caught short or caught underexposed. That's not a rumor. That's institutional reality. MKS PAMP operates in the physical market. That means real metal, real delivery, real lead times, and real constraints. They refine metal. They facilitate delivery between mines, mints, dealers, banks, and industrial buyers. So when their CEO says demand is unprecedented, he is not staring at a chart trying to guess. He is looking at order books. He is watching metal flow. And in Bloomberg's interview with Emmett, the physical market is under stress like never before. That kind of stress doesn't show up first on a candlestick. It shows up first as, we need metal now. Now here's the data, and I want to keep it simple. Silver more than doubled in 2025. Best annual performance since 1979. That is 46 years. And in 2026 so far, it's up another 50%. On Monday, silver hit a new all-time high above $117 per ounce, with the biggest intraday jump since the 2008 financial crisis. As of today, it's trading around 110 to 112 after some volatility. But this isn't a flash crash recovery. This is a structural repricing, meaning the market is being forced to revalue silver because the underlying setup is changing. In plain terms, it's not just people got excited, it's the system is recalculating what silver should cost when supply can't keep up. And both Citi and MKS PAMP are confirming the drivers are still intact. Emmett laid out the physical situation in terms that should make you stop and think. Retail and wholesale orders are outstripping available supply. Massive flows to India continue to squeeze the global wholesale market. So even when the screen price moves, the real-world pipeline is still tight. And here is the detail that confirms everything we've been saying. Silver is now being air freighted instead of sea shipped. Emmett's exact quote, "Now you simply can't wait for containers to drift across the ocean that long." Pause on that. Air freight costs multiples more than ocean freight. You only pay that premium when urgency beats cost, when buyers are willing to absorb extra expense to secure metal immediately because waiting means losing access. And that is the key, access. In a tight market, available becomes more important than cheap. This is not retail stackers panic buying coins. This is wholesale industrial and investment demand operating in a market that cannot deliver fast enough at the current price. And when wholesale demand is the driver, it doesn't need a viral headline to keep pushing. It keeps pressing because it has orders to fill. When you are air freighting silver, you're admitting the supply chain is broken. You're admitting that physical availability is the bottleneck, not price. Now connect that to Citi's forecast. When Citi models a $150 target in 0 to 3 months, they are not just extending a trend line. They are pricing in risk scenarios. They're looking at what happens if the wrong side gets trapped, if liquidity thins out, and if the move accelerates faster than positioning can adjust. They see the same physical tightness Emmett is describing. They see speculation building on top of it. And they are telling their clients the market could move violently because the structure is unstable. Their note explicitly stated they've been bullish on silver, both outright and relative to gold for many months, and remain so over the coming weeks. Outright bullish means they expect silver to rise in absolute terms. Relative to gold means they expect silver to outperform gold, which historically happens when industrial demand surges or when catch-up dynamics kick in after gold rallies. It's the same theme, two ways, up and up faster than gold. Now here's the speculation layer that Emmett addressed directly. He said, "You are definitely seeing more price action driven by short-term players in the future. Silver traditionally isn't a heavily speculative market compared to gold or equities. It's smaller, less liquid, more industrial. But now, according to the CEO of one of the biggest physical players, speculation is driving volatility. Why? Fear of missing out." Investors who skipped the gold rally or arrived late are now using silver as a high beta substitute. Bloomberg framed it as a major bet on macroeconomic turmoil and geopolitical risks. So silver becomes the faster version of the same trade. And that attracts momentum money. When speculative money floods into a thin market, you get explosive price action in both directions. Emmett called this a devaluation trade, money flowing out of bonds and currencies into hard assets. But silver's moves are faster and more volatile than gold's because of the liquidity gap. According to the Bloomberg interview, gold's daily London turnover is about 5 times silver's at current prices. That means it takes less capital to move silver dramatically. So when big money wants exposure and the market is thin, price discovery gets violent. Violent up and violent down. That's what thin markets do when they get crowded. We saw that on Monday with the biggest intraday jump since 2008. That's not normal. That's a market under stress. And both Citi and MKS PAMP are confirming it. Now let's shift to the technical picture because it matters. Even in a market like this, silver broke above its 200-day moving average with conviction weeks ago. Volume was strong. The relative strength index on the daily time frame is elevated but not extreme. We've seen RSI divergences before major moves. And right now, momentum is still building. The 50-day moving average crossed above the 200-day recently. That's the golden cross signal technical traders watch. In simple terms, it's a sign that the shorter-term trend has flipped above the longer-term trend. And when enough traders see the same signal, they often act the same way, which can intensify the move. When fundamentals and technicals align like this, it amplifies the trajectory because it pulls in more momentum-driven capital and it reinforces the move. So Citi's $150 target is not just a fundamental call, it's also an acknowledgement that technical momentum and physical reality are reinforcing each other. Now here's the mid-video reveal, the part most people don't want to say out loud. Here's what I think is really happening that neither Citi nor MKS PAMP will say directly. The paper market is losing its grip on price discovery. For decades, COMEX futures and LBMA forwards have set the global silver price. Physical metal traded at small premiums or discounts to the paper price. But the paper price was the benchmark. That system worked when physical supply could meet demand at the futures price. But when demand overwhelms supply, when metal has to be air freighted to meet orders, the paper price becomes less relevant. Not because paper disappears, but because physical stress starts to dominate what buyers are actually willing to pay. Physical buyers start paying whatever it takes. That's when premiums explode. That's when arbitrage breaks down. That's when futures markets either deliver metal or go into backwardation. And if that sounds technical, keep it simple. It means the market starts paying more for now than for later, because now is scarce. We are not fully there yet, but the cracks are showing. Emmett's comments about air freight and unprecedented demand are symptoms of a market transitioning from paper-dominated to physical-dominated price discovery. And Citi's 50% target upgrade is their way of telling clients the old models don't apply anymore. When a market shifts from adequate supply to structural deficit, price has to rise until demand destruction occurs or new supply comes online. But new mine supply takes years to develop, and industrial demand for solar, EVs, electronics, and defense is policy-driven. It doesn't stop because price rises 10% or 20%. It adjusts, absorbs the cost, and keeps buying. Now let me address the bearish case because balance matters and risk is real. First, volatility. Silver can spike 20% in a week and give back 15% in 2 days. Emmett explicitly said short-term speculative players are driving price action. That means momentum traders, algorithms, and leverage. When leverage unwinds, corrections are brutal. If you're trading silver with tight stops or high leverage, you can get stopped out on a spike down, even if the long-term thesis is correct. That's the risk. Second, recession. A global economic slowdown could temporarily crush industrial demand. If solar installations stall, EV sales drop, and electronics demand weakens, silver gets hit. That's a legitimate concern, especially if central banks raise rates aggressively to fight inflation. But here's the counter. Even in a recession, green energy spending is politically entrenched. Governments subsidize it. It's part of infrastructure policy. The energy transition is not purely market-driven, it's policy-driven, which makes it more resilient to cyclical downturns. Third, supply response. Maybe a major new mine comes online, or recycling rates surge, or industrial users find substitutes. Possible, but unlikely in the near term. Mine development takes 5 to 10 years. Recycling is already factored into supply models and hasn't kept pace with demand growth. Substitutes exist for some applications, but silver's unique properties, especially conductivity, make it irreplaceable in many high-tech and energy applications. These are long-term buffers, not 90-day fixes. Fourth, Federal Reserve policy. If the Fed pivots back to aggressive rate hikes, real yields spike, and precious metals get sold. But current Fed rhetoric suggests they're in a holding pattern or potentially cutting if growth slows. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. And if inflation stays sticky despite rate hikes, real yields stay negative or low, which supports hard assets. The macro backdrop right now favors silver more than it hurts it. But let me be clear. These risks are real. Silver is volatile. Citi's $150 target is a forecast, not a guarantee. Emmett's comments about unprecedented demand are observations, not predictions. Markets can turn on a dime. If you're holding physical silver, understand price could pull back 10, 15, 20% before the next leg up. If you're trading, understand leverage and tight stops can get you shaken out even if you're ultimately right. Risk management is everything. Now let's talk about what this setup means, depending on where you are. If you're holding physical silver, this is validation. You're not crazy. The fundamentals are real. The supply-demand imbalance is real. The industrial demand is real. A major bank and a major refiner just confirmed it on the same day. Patience is hard when prices whip around, but structural bull markets don't move in straight lines. They build over time, consolidate, and then explode when the pressure gets too high. We might be entering that explosive phase now. If you're trading, Citi's $150 target in 0 to 3 months is aggressive. If we hit 150 and the drivers are still intact, the next leg could go higher. But remember, volatility cuts both ways. Emmett's comments about speculative players mean momentum can reverse fast. Use stops. Manage position size. Don't over-leverage. No one knows the exact path or timing, but the setup is there. If you're on the sidelines, you just got 2 major signals. A global bank raised their short-term target by 50%. The CEO of one of the world's largest refiners said demand is unprecedented, and metal is being air-freighted due to urgency. You can dismiss that as noise, or you can dig deeper and decide if the evidence supports the thesis. I'm not telling you to buy. I'm telling you to think critically, verify the data, and make your own informed decision. 3 takeaways. 1. Citi and MKS PAMP both confirmed on January 27th that silver's market structure has fundamentally changed. A 50% price target upgrade and unprecedented physical demand are not coincidences. 2, the drivers are structural, not speculative. Industrial demand, supply constraints, geopolitical fragmentation, and monetary policy are all pushing in the same direction. 3, the paper market's control over silver pricing is weakening. When physical buyers are willing to air freight metal at massive cost premiums, the futures price is no longer the real price. Physical availability is. The unresolved tension is timing and magnitude. Will $150 happen in 30 days, 60 days, 90 days, or will we see a correction first? Will speculative momentum amplify the move or trigger a violent shakeout? No one knows, but the setup is there. The fundamentals are there. The institutional and physical market validation is now there. Do your own research. Verify every claim I've made. Understand your risk tolerance. Don't invest money you can't afford to lose. Don't invest based on hype, fear, or someone else's forecast. Invest based on evidence, logic, and a clear understanding of what you're getting into. Invest with logic, not hype. The metal alarm desk out and about. Let me know in the comments. With physical urgency rising and paper strains showing what wins next, a fast $150 print or a violent shakeout before the next leg higher,